Hey there, and welcome to another edition of the Next Gen podcast. I am your host, Nick Leese, and I'm excited to have you here today because I'm going to talk about something that I get a lot of confusion about in the marketplace. It's something that's been around for a while. A lot of people have heard about it, but a lot of people still don't understand what it is and how it works, and that is level funding. Unfortunately, a lot of businesses have been misled on what it is. Some of them are using that strategy and don't currently understand exactly how it does work. But there's people that have explored the strategy but have been scared away because they don't understand how it works. So the goal of today's podcast is really going to be to distill down what is level funding, how does it work, and why is it a potential good fit or potentially not a good fit for your business. I'm Nick Leese, founder of Next Gen Benefit Solutions, and we are on a mission to help 5,000 people achieve access to quality, affordable healthcare in the next 12 months. So let's dive into this topic of level funding and see if we can get you a better understanding of how it works. So one of the ways that I like to explain level funding, and one of the best ways that I found to explain it, is by using a bucket methodology. So one of the ways that level funding is like fully insured is that you get a consistent monthly premium. So in this example, we're going to use a premium level of $30,000 a month. Okay. Now, level funding at the end of the day, and this is something I want to get out of the way, at the end of the day, level funding is self-funding. Now, it's not self-funding like Amazon and Walmart do. It's different than that. The strategies they deploy are unique to a very, very, very small sliver of businesses. We're talking about self-funding that is more commonly found in groups under 5,000 and, even under 1,000, 5,000. Again, maybe they have a few strategies that some of these smaller groups don't, but we utilize stop loss contracts, and that's something we'll dig into. But getting back to how the monthly premium is allocated, level funding is really just a cash flow management strategy. So the fear a lot of small to mid-sized businesses have with self-funding is that they simply can't manage the cash flow. They can't have $10,000 worth of claims they have to pay this month and $100,000 next month. That's something that their business just cannot handle. So they need it to feel a little bit more like that fully insured, where they have a consistent monthly premium. So what we do is we take the expected cost. In the case of my groups, I like to take the maximum expected cost, and we establish a monthly premium based on that. So again, based on a $30,000 monthly premium, we're looking at a $360,000 annual premium for a group. Okay. So where does the money go every month in this level funded strategy? Well, that's where we have our three buckets. And these three buckets allow us to bring that consistency and predictability to you. So although it's not broken up by exact thirds, for the example, and to make it easy, we're going to assume that a third of your monthly premium goes into each of these buckets every month. So the first bucket is an admin bucket or an administration bucket. That's the bucket where we pay your third-party administrator to manage your plan for you. That's where we pay, maybe some network access fees or reference-based pricing vendor fees. Maybe you have a diabetic program. We're going to pay that out of the admin. Telehealth, that comes out of the admin as well. So really paying all the different vendors to manage your plan for you is going to come out of that admin bucket. Now we get to the second bucket, and that bucket is called stop loss or reinsurance. So as I had mentioned previously, when we're talking about what I would call normal businesses, not Amazon and Walmart, we have to cap the amount of risk that the business can take on. And so the way that we do that is we do it through stop loss. So in the case of a level funded program like we're talking about with a $30,000 monthly premium, $360 annually, that would be assuming that we're going to have a maximum risk of $120,000. So anything over that $120,000, And we'll get into what specific deductibles are here in a minute. But essentially, the stop loss contracts just protects and make sure that we don't um, allow your business to take on any more risk than what you're comfortable with. So again, about a third of your monthly premium goes into paying for that stop loss contract. Now, the third bucket's the fun bucket, or at least I think it's the fun bucket. That's where we're setting money aside to pay your claims. So assuming you're a 1/1 renewal date, January 1, you've paid your premium. We're going to take $10,000 of your monthly premium and we're going to set that in a bank account specifically to pay claims. So when your people start having claims in the plan year, we're going to pay those claims out of there first. Now, one of the questions I get, and it's a great one, is Nick, okay, so we start in January, we've got $10,000 in our claims bucket, but February 1st, somebody has a $20,000 claim. Are they going to ask us for more money? Well, if you don't structure the contracts right, there's a possibility, but all of the contracts that we use, it's a no. We leverage the stop loss carrier, the TPA. Sometimes it's different. It's usually a stop loss carrier that's going to provide what we call an aggregate accommodation. And essentially what that is it's an advance on claims. So you have your $10,000 sitting there, $20,000 claim happens. What they're going to do is they're going to take 10,000 of your dollars. They're going to pay towards the claim, and then they're going to advance you the rest of that. So in February, when you pay your premium, there's going to be $10,000 that gets allocated for the claims bucket. They're going to take that 10,000 then and repay themselves. So you're going to be sitting at zero in February. But let's assume that you have a really good year or a really good couple of months rather, and you're putting $10,000 a month in there, but your employees are only using 5,000 of it. Well, the next thing you know, you have $15,000, $20,000 sitting in that claims fund. And that's where, you start to run that surplus level. The good thing about the claims bucket and why I say it's the fun bucket is that at the end of the contract, we do what we call a run out period, which is typically about 6 months. And at the end of that run out period, any monies that are left over in that claims bucket come back to you. Now, I say any monies, there's different ways that you can structure it. I try to use carriers or TPAs and stop loss carriers that will allow you to have 100% of your excess returned back to you. But some of them do only have 50%. And there's certain clients that they don't want refunds. They just want the lowest possible cost. So they might select to forfeit any type of refund in exchange for lower rates throughout the year. But at the end of the day, it's a great opportunity for you as a small to mid-sized business when your group is running really well, your people aren't using your health plan a lot, to get some of those dollars back. So let's walk into, since we kind of understand how the money flows in a level funded contract, how we use level funding to bring that predictability to your business, let's walk into some of the risks, some of the rewards, and how to make sure that you're properly structuring your program to protect your business. So there's a couple of risks that I have seen over the years that a lot of people maybe don't quite understand. So one of the risks that is out there is fluctuations. And this is going to be kind of a clue for some of you of why level funding may not be a good strategy. So January 1, we put the plan in place. You have 35 employees on your health plan. Okay. The contract will have in there somewhere that the stop loss carrier reserves the right to recalculate or to re-underwrite your group if your census fluctuates more than 10%. Some of them might be a little bit more. I don't know that I've ever seen one that was less. But on a 35 life group, that means that if you lose 4 people, you fall below that 10% threshold and you run the risk of the stop loss carrier re-underwriting your group, which can make your rates change. Now, that's not a reason to be scared, but if you're a business that, constantly sees fluctuations up and down, level funding maybe isn't the best fit for you. Now, if you're just one of those businesses it's very cyclical or not cyclical, but you have a high turnover rate. So you might hire 10 people and 10 people leave in the same month. That's not so bad because we have that consistency. You're consistently seeing about the same amount of employees on your plan every month. Now, um, the other side of that is you're a high growth company. You're adding, 10 new people a month. That's not a problem. They don't typically have an issue with your your census getting bigger. It's only if you have 35 people and 2 months later you're at 25 people. That's when they get nervous because they have assumed these contracts based on 35 people paying premium or premium being paid on 35 people. And so it throws their numbers off, and that's why they put that reserve in there. Um, I can't think of a situation where I've ever actually seen that triggered. Have been in a situation or two where we've had that 10% decrease in census, but it was very minimal. And so we were able to make an agreement that, hey, we lost a couple of people, but this wasn't intentional. This wasn't something we were expecting or anything else. And they worked with us and did not adjust any type of rates. Now, one of the other issues that I have seen out there in the marketplace is funding to the minimum versus funding to the maximum. So the underwriters are going to give you an expected cost. They're going to give you a minimum expected cost. They're going to give you a maximum expected cost. Okay. Some groups choose to, and it's not a bad strategy, and make sure that you keep more money into your pocket. But if you fund a contract to the minimum expected, and you wind up going over that threshold, there are situations where you may owe some money back to the stop loss carrier for claims that were incurred because they're planning for the maximum. Quickest way to solve this problem is to fund the contract to the maximum. That's one of the things that I really recommend groups do. All of my groups fund to the maximum. And the reason being is that way they don't come to the end of the year and have to come up with, $5, $10, $20,000 to kind of fund that corridor between the minimum and the maximum aggregate. So those are a couple of things. Probably the only other downside to a level funded program in some aspects, but a really beneficial one in the other, is the fact that we have to underwrite your group. Traditionally, that has been done with health forms, usually 3 to 5 pages of questions asking your employees their health history over the last 5 to 10 years. And those can sometimes rub employees the wrong way. They're kind of a hassle. The good news is that with technology, we're able to do that much more efficiently these days. Frankly, a census with name, date of birth, and zip code on it for all members of the health plan, both employees and their dependents, oftentimes can get us a firm rate just from that. We put it through what we call a GRX underwriting, which uses an algorithm to underwrite your group. And believe it or not, I found it to be really pretty darn accurate. It does a good job. Now, occasionally we'll run them through GRX and we do have to collect health forms, but instead of collecting health forms on all 35 of your employees, it's usually around 10 to 15%. If we have to collect health forms, that is 10 to 15% of your group. So, we're talking 3 to 5 people on a 35 life group that we're going to need to wind up collecting a health form from. And that's really just because the algorithm came back with a high risk score for this person. So the underwriters are just wanting to get a little bit more information so they can properly assess your group. Now, again, this is a little bit different from fully insured. With it fully insured, it's, if you're under 50, it is a guarantee issue. It's community based. The rates are what the rates are. Your company gets the exact same rates for a 35-year-old female as the company next door. So that is a little bit different. And like I say, kind of that little hurdle of doing the underwriting process can be something that deters some groups. But let's talk about why it's actually a good thing. So underwriting allows the insurance company, the stop loss carrier, to actually assess the risk of your group. So maybe you're an extremely healthy group. Maybe your demographics are 80% male, ages 25 to 45. Those are pretty good risks in the eyes of an insurance carrier. 25 to 35-year-old males tend to not need the doctor a whole lot. They're going to some general maintenance, as I like to say. But the chances of heart attacks, major cancer, stuff like that are fairly low in that group. Really, the big claims come from the fact that they're 25 to 45-year-old men. But again, going back to the underwriting process, if you've got a relatively healthy group, if your demographics look good and everything else, your rates are going to be based on the risk of your group, which is something that you don't get in fully insured. So what we'll oftentimes find is that a level funded contract in a group that gets a decent underwriting, you're going to save 10 to 15%. That's not a hard and fast rule, but I would say at least 10 to 15% over a fully insured contract. And I've seen it get much bigger than that. I like to set the expectations low, kind of do that undersell and over deliver kind of scenario. But I would tell you on average, it's probably 10 to 15% below fully insured. So if you're fully insured today, you want to save some money. The underwriting process is a little bit of a hassle, but it can generate some big savings. And if we're talking about a $300,000 premium, that's 10% is $30,000. If we get 30%, which I've seen before, that's $90,000 back to your bottom line that you can use for raises or capital investments, whatever you choose to do. So anyways, those are a couple of the drawbacks of level funding or self-funding, because that's what it is at the end of the day. But let's talk about some of the really good things. And we've kind of already started to address some of these. Probably the number one thing, in my opinion, goes back to the rates are based on the health of your group. So if you have a healthy group, you're going to get the best rates through a level or a self-funded program. One of the other things, going back to the claims bucket, with fully insured, a lot of people say, well, it's less risky. And I would say, well, if you spend $360,000 this year and you have a pretty healthy group and your employees only use $50,000 worth of claims, seems like the insurance carrier got a huge win there. But if you're in a level funded contract and you're funding in $120,000 to the claims fund of that total $360,000 premium, your people use $50,000. That means you have $70,000 left over to do things inside your business. You can, throw an employee appreciation party. You can do premium holidays. You can buy down deductibles, whatever you want to do. You can do that. And speaking of deductibles, that's another huge benefit of a self-funded, level funded type contract, is that we get a ton of flexibility. So as you know, in the fully insured market, they've got X amount of plans. Usually it's, 12, 16, 24 plans. But you have to pick from one of those plans. And there's a lot of times not any one of those plans that really fits your group the best. And so with a self-insured world, one of the good things that we can do is we can take those not monthly premiums, those plan designs, and we can make them to actually fit your employees. So maybe you want a little bit lower deductible. Maybe you want to lower some copays. Maybe you want to raise copays on certain areas to help people make better decisions. We can do all kinds of things. There's a lot of flexibility in those programs. So that's a huge benefit. And then kind of the fourth thing is, when it comes to compliance, there's a few more compliance things that have to be done with self-funding, but there's a few things that it helps you do better at compliance. So with a good self-funded program, they're not all created equal, but with a good one, you're going to get a lot of access to the data that you need to make good decisions. So you're going to be able to see where is my money being spent? Is it being spent efficiently? Can we implement strategies to help, guide people to lower cost care? Can we, leverage the health plan and the design of the health plan to make sure that people are getting good quality health care? These are all important things. It's something that fully insured doesn't do for us. And it's something that in a level funded program, you have a lot more flexibility in that. You have a lot more flexibility in helping to control the cost, which brings a more consistent um, kind of a more consistent year to year program. And so, with fully insured, it's year to year, it's going to go up 5, 8, 12% next year. Level funded can do the exact same thing, but you have a lot more controls to make sure that your plan is running well and reducing the risk of that happening pretty substantially. So at the end of the day, we're going to wrap this up with, are you a good fit for level funding? Well, let's talk about the groups that are under 50 employees right now. And some people don't agree with this philosophy, but if you're a group that's under 50, and especially if you're comfortably under 50, every state in the nation has an ACA program to where if a level funded, self-funded program winds up that it's no longer the right fit for you, you can always go back to one of your big carriers that offers a fully insured contract. So the situation there is like, well, what happens if we get brain cancer? That's a real risk. That's something that we need to be aware of. That's something that we need to plan for. But if you're under 50 and your self-funded program, quote unquote, blows up, we go back to fully insured. It's not a big deal. The only downside to that is it creates change. Obviously, fully insured is going to be more expensive. But if you run into one of those scenarios where level funding is no longer a good fit for you, you can always go back to fully insured. But what I like to tell people is, if you've got a healthy group, go level funded. Save the money as long as you can. I've got groups that were in level funded programs for a year or two, and then they needed to go back to fully insured. I've got other level funded programs that have been very happy with what they've had for 7 years straight now. It really just comes down to, what's the right fit for you. If you're a group that's looking to save some money, you're under 50, I would tell you that you really need to be looking at level funding. Again, make sure you've got the right advisor. You need to make sure everything's structured to make sure we protect you as a business. But it can be a really great strategy for a lot of businesses. Now, let's talk real quick about the businesses that are over 50. Okay. With the exception of a few states, all the states I operate in, once you get over 50, the big fully insured carriers do use an underwriting methodology on your groups. So if you have something going on, they are at least partially setting your rates based on the risk of your group. So there, it's kind of a toss-up. If you have a major event going on, fully insured may become wildly expensive because of that health risk. Self-insured level funded can become expensive. Probably the only big advantage there when we're talking self-funding is, again, control. When we have a big cancer, or maybe it's a rare condition where we're having to do infusions, we have a lot more flexibility in how we control how that medical care is provided. So, for example, with infusions, if a drug is infused inside of a health system, a lot of times it's going to be more expensive than if we have a nurse come to your employee's home and do the infusion right there. And I would argue that getting the infusion in the comfort of your own home has its own perks. But with that self-funding, we have a lot more control. We can better manage the risk of that high claimant and really pull some different levers to help make sure that we keep it affordable for you and your employees. So again, as you guys know, sometimes I bounce around a little bit. I hope that you guys followed me through this conversation. At the end of the day, level funding is a really great strategy for a lot of small and mid-sized businesses. It's one that I think is probably underutilized. And a lot of it comes down to people just don't understand what it is. So I'm hoping that this podcast helps you better understand what level funding is, why it might be a good fit for you. And if you have any other questions on it, feel free to engage with me online, give me a call, shoot me an email. Would love to talk to you about how level funding can work in your business, and be happy to show you kind of what that would look like. So with that being said, Thank you for tuning in to this edition of the Next Gen podcast. We appreciate you and we look forward to talking to you again soon.